Wall Street is known for taking risks, that's for sure. We can look back a few decades and see that this has become more commonplace as bailouts and favorable regulations have made any method of gambling very easy and profitable. However, despite all of the unprecedented risk, the actual economy has weakened tremendously. What's really going on? You came here for the truth, so let me unveil that for you. Today we are going to look at, despite all of the risk that we have seen going on within Wall Street, it has not translated into a booming economy. I'm going to show you the examples of this today as we look into the different factors that I've been able to pull together, so let's get into it right away. One interesting indicator, if you want to tell what's happening with the economy, is to look at the big rigs. Look at the orders of these 18-wheelers, and you can get a sense of what's been happening. We can see that this had peaked out last year and has been declining ever since. The numbers go up to December, and so we saw this happening just like all of the other indicators have shown about middle of 2018 when the QT really started to take effect, even though it was very minuscule. We saw the slowdown that was taking place in China as well as other places started to come around, and this is clearly evident with the Class 8 net orders. This shows you one very interesting example of the way that things can move in an economy. No, we're not looking at PE ratios. We're not looking at 200-day moving averages. This case here, we are looking at the 18-wheelers where companies are placing these orders, and this has declined month after month after month. This is out of Deutsche Bank. Transportation prices are rising. You can see the Cass Truckload Line Haul Index. I don't know what this index breaks down into specifically, but since the financial crisis, this has continued to get worse and worse. If we see these prices rising, it's going to obviously put a burden on all of these companies, on all of the customers, and the economy suffers as a result. What has happened with the Federal Reserve doing a complete 180 has been that risk is back on the table. Essentially, that's what this article is talking about here. Take a look at the first line. The Federal Reserve risks stoking the same sort of asset bubbles that Chairman Jerome Powell has linked to the last two recessions with its newfound eagerness to fan inflation. So they could go overboard here. And if you look at real inflation, not the fake core PCE inflation that they use, you can see that it has made its way into the real factors, whether that is with food in some cases, with energy in other cases. Of course, we have noticed this for quite some time. Our expenses continue to go up. If you look at, for example, packaged food, you get generally smaller packages, or if it's the same package, they're putting less total food in there. So for the dollars, you're getting less. At the same time, the prices have risen, so you're getting double screwed over. That's just one simple example, but people can relate to that. I don't know about in your city, but in Toronto, those cash advance type businesses have opened up everywhere. This is one very extreme example of that. Stephen Marley comes from music royalty. Sean Garrett has written and produced smash hits for Beyonce, Usher, and Ciara. Even so, when they and hundreds of lesser known names in the world of hip hop and rap need cash, one Wall Street figure emerged as an unlikely source behind the financing. Hedge fund titan Jamie Dimon. No, not Jamie Dimon, although their names are quite similar. This particular company offers cash advances to musicians who often have to tide themselves over between royalty checks that can take months to arrive. A big selling point is that unlike a loan, it's quick and easy. No credit checks or hassling with banks, just your money fast. Doesn't that sound like those cash advance place, your payday advance place that you have around the corner? Don't worry, no credit checks. You get your money, it's right here. There's just one little bit of fine print that the interest rate is extremely high. In the bottom paragraph, they basically get into the fact that, oh no, it's not 4% as you would see in the market generally with loans. Oh no, some artists can end up paying rates of 30% or more. And because they're structured as advances instead of loans, state usury laws don't apply. I understand that some people, they're desperate, they need the money, they go to these places, they use them, and so they get what they need to, but it's not a permanent solution. If people are constantly going there, this is going to bury them. Debt is going to ruin them very fast. The interest rates are extremely high and should only be used in an absolute last line of defense type of emergency. One of the biggest risks to the financial system right now, today, is the triple B rated bonds, the junk bonds, as far as I'm concerned. Triple B rated corporate bonds had the best quarter since 1995. And why is that? Well, quite frankly, it's because there has not been a very good return on other types of assets. So they seek more of that alpha. They want some money. They want some profit. So they've been going this route. 6% return in a time when other things have not been giving them any money, particularly in the fourth quarter of 2018. However, as I have disclosed many times before, it doesn't take much for these to go into junk category, and then many of these funds they are required to sell them because they can't hold them. They're just above the junk status as far as I'm concerned. It's junk, and a simple little change could make them have to sell all of these off. That is dangerous. That is extremely dangerous, not for those holding these funds, but for these companies that have been buying them up at record rates, as well as all of the other funds, because it's a trigger that could be set off. And I'm very concerned about the triple B. We've talked about this before, of course. And that brings me into my next point. This article is actually from the end of 2018, but it leads me into the next point that I wanted to make. U.S. leveraged loan funds saw $3.3 billion of net outflows in the week ending December 19th, the biggest outflow on record. Investors pulled $3 billion from mutual funds that buy the debt. That was back in December. Well, guess what? It never stopped. Just like what we have seen with equities, where they've been selling off, investors have been selling and selling and selling for months and months now. We have watched the same exact thing with these loan funds. Take a look at this out of Bloomberg. Fed-fueled flows. ETFs tracking loans have seen huge outflows in the past 2 weeks. In fact, it's been going on basically for a few months, but this is specifically in the past couple of weeks that this has been in the negative. And then you're looking at this. Fund flows summary on the left hand side. You can see they've highlighted loans. It just shows you year to date, the performance not good in terms of where the money is going in and out of. On the right-hand side, same thing. They've been selling off of those loans. And one more chart along with that, weekly loan fund flows. I believe this is 19 weeks in a row. They are selling off. But let me tell you something. Can you believe it? That their performance is really good today. How does that make any sense? Just like with equities, we have seen an anomaly appearing in the markets where we have persistent selling and yet the performance is fantastic. Look at what has happened since the end of December up until present with equities. They have gone up considerably, 25% for some of these markets. That's a generalization. Some have done better, others have done worse. Doesn't matter. They've all performed very well in general. And that has come upon all of the selling that's been taking place. All of the fund flows show it. The EPFR data proves that, and the same thing is happening with the loan funds. There's something very fishy going on here. I have done videos about this over and over and over again, and yet most people out there don't want to believe it. But if you are here and you're watching to this part in the video, you simply want to know the truth. Well, here it is. We are witnessing something that's freaky. It's like a ghost in the system. There is nothing here that makes any sense at all. It's as if there's some entity out there that has been buying all of this up secretly while everyone else is selling, and then you have a few retail investors and a few others out there that are buying shares here and there, but it's not showing up in the statistics. The statistics show us that we are currently seeing net selling taking place in the markets, whether that's the loan funds, whether that's equities, and on the opposite end of the spectrum, fixed income is seeing money moving towards it. So people are in seek of safety. Where they are buying the stocks, we see that they're buying more defensive positions. They're trying to shuffle around their risk. I still believe that they are very, very risky in some cases. When you look at some of these so-called investments that they're into today, I'll tell you something, the markets since September or October of last year have been broken. I don't know what's gonna happen, but this is not good. This is just more evidence on top of everything that we have been talking about. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you are supporting this channel, so I do appreciate that very much. If you want the financial education that you weren't taught in school, that was kept from you, kept from the school system intentionally so you couldn't learn it, then you read these two books. You got everything you need to know. Check them out at the link in the description if you want the audiobook that's available at themoneygps.com. If you want to find out more data about the EPFR, what the investors are selling today, you can see the equity, see the fund flows. I break it down in this video. Click on it and I will see you there.